Great. Good afternoon, everyone. This is Ken Hurley with One America. Thanks for taking the time and joining myself and Nick and Dan from OCI. So we're going to talk a little bit about long-term care planning, and really the first thing that I want to address is so often when I talk to financial professionals and insurance professionals about long-term care, they really struggle with how do you have the conversation? What do you say to your client? And it's important to have that conversation. And I'm going to hit you with a little statistic that's a scary number. So there was some market research done about 7 years ago. And the market research was to 1,000 people that had bought long-term care insurance, both traditional and asset-based products. And what came from this data was that 87% of the people that bought some type of long-term care insurance policy, like I said, whether it was traditional or an asset-based being a life product with long-term care, which we're going to talk about today, 87% of those people said they had to initiate the conversation with their financial planner or insurance professional. Now, probably not the best way to start off a conversation or my webinar, but I'm going to say it anyways. That's pretty pathetic of us as an industry, and we're not doing the right thing for our client. We should be talking to them. So the good news is there's clients out there that want to know about what they can do to help their clients with long-term care planning. And many of those clients that are out there, the reason that they initiated the conversation with their financial planner or insurance professional was because they didn't have the conversation with them first. So I would ask that when we get done today, you think about some clients as we're talking. Who should you be talking to that you know doesn't have a long-term care plan? Because there are people out there looking. When I look at some of the top producers of long-term care products in the country, and this is my 30th plus year in the industry, there's a lot of producers and financial planners that sell long-term care planning full-time. And one of the ways they're generating leads is through the internet. And who are those clients? Well, those are your clients that potentially you haven't had a conversation with, and they're concerned about long-term care planning. And so they're looking for long-term care planning. So anyway, let's jump right in. Let's go to the next slide and the first two questions. Now, as I said, it's hard sometimes for somebody that doesn't write a lot of long-term care and doesn't have these conversations often. They struggle with, well, how do I even bring this up, this topic of long-term care planning with my client? So there's two questions, and these two questions I've been using, and I've worked with hundreds and hundreds of producers and financial planners that have used these questions, as have many in the industry for many, many years, and they are gold. And they're pretty simple questions. First question, you may never need care, but if you did, how would that affect your family? Well, let's talk about it. How would it affect your spouse? Think about this. For those of you who have a spouse or a significant other, and you're in your 40s, 50s, maybe your 60s, maybe you're even younger, can they lift you in and out of bed, on and off the toilet today? And if they can't do that for you today, think about when you're 80 years old. So it could be tough on a spouse. Let's talk about the adult children. Well, with most adult children, they've got their own families to take care of. I'll just throw it back into my own family right now. So my mother, who's 82 years old, about 6 weeks ago fell taking the garbage out and broke her kneecap. My parents live in a two-story home, and there's only a half bathroom downstairs. My mother can't go up the stairs because she can't walk up and down the stairs. We had to bring in a hospital bed to take care of her. My father is 87, early stages of dementia. He's not in a situation that he can take care of my mother. So my parents have 24-hour-a-day home care. Now, granted, it's only going to be for about 3 or so months, but they're having 24-hour-a-day care. How can it affect the children? Well, how it affects the children, let's talk about my family once again. My two sisters have decided that they want to take care of my mother on the weekends. So they're taking care of her, and I'm not. Why am I not helping out? Because my mother doesn't want me to have to help her use the bathroom. So now, fortunately, my family, we're all in the long-term care industry or the medical field, so we understand it. And so I've had the conversation with my two sisters that I don't want them to be upset because I haven't done anything to help. So they have me do other things that I am capable of doing, some yard work and some of those types of things to help out. But it can tear families apart. So the family dynamics can play a big role as well. Maybe, like in my case, we have my middle sister. I'm the youngest. I have an older sister, two older sisters. My middle sister, she's kind of the controlling one in the family. And that can play into some of the family dynamics. Last thing, the finances. I'm not going to tell you how much my parents are paying because you wouldn't believe me if I told you, but I'll just tell you it's well in excess of $10,000 a month. Now, I live in California, so the costs are pretty expensive to begin with, but it's very expensive. Fortunately, my parents have long-term care insurance, so it's covering a big part of the bill for them, but it's a very expensive thing, so how can it affect the finances? Then we go into the second question, and if you did need care, how would you pay for it? Well, some clients might say to you, well, I'm going to let the government take care of it. Well, great. Let's talk about the government. There's really two components when you think about the government. With the government, it's either Medicare, which, as we all know, Medicare doesn't pay for long-term care. Medicare was designed to pay for hospital stays and doctor visits. It was never designed to pay for long-term care. And then there's the other, which is nobody wants to be on, which is Medicaid. Medicaid means welfare. How do you qualify for welfare? You have to be poor. Well, let's use my parents, for example. If they didn't have long-term care coverage, they'd be paying out of pocket until they got to a point where they spent down essentially their life savings, sell off all their investments, down to the poverty level. Then they'd qualify for Medicaid. So Medicaid's not a great answer. And more importantly, in most states, Medicaid only pays for nursing home care. My mother's at home. She doesn't want to go to a nursing home. She doesn't need to go to a nursing home. 90+% of the people that receive care today stay at home. Medicaid doesn't pay for home health care in most states. What about long-term care insurance? Well, long-term care insurance is a great solution if you have long-term care protection. That's wonderful. There are some risks with long-term care, traditional long-term care insurance. We've seen companies have rate increases. We've seen the lifetime benefits virtually go away. And so the traditional long-term care insurance isn't necessarily the greatest solution anymore, but I applaud anyone that has a policy because they're far better off than somebody that doesn't have anything at all. Then there's asset-based long-term care coverage, which we're going to talk about today. And lastly, people say, well, I'll self-fund this. Well, that's just great, but let's talk about self-funding for a minute. You know, self-funding for most people around the country means anywhere from probably as little as $40,000 a year to upwards of $120,000+ a year, depending on where you live in the country and depending on the type of care you need. Let's just make it a round number just because I'm not the smartest guy in the world. Let's keep the math easy. Let's say it's $100,000 a year that the cost of your long-term care is. And oh, by the way, you weren't self-employed, you worked for a business. And one thing you did really well with your retirement is you put as much money away every year as you could into your 401k. And so now most of your money is qualified money. But you've got, let's just say you've got $1 million. Most people would say $1 million is a lot of money, and that could pay for a lot of long-term care. However, it's in qualified accounts. So now I need $100,000 a year. Do I need $100,000 a year, or do I maybe need more like $125,000 to $140,000 a year, depending on the tax bracket you're in and the state that you're in? Because in order to clear $100,000 to pay for your long-term care out of a qualified account, you'd probably need to take more like $125,000 to $140,000. So that money goes even quicker, and people don't think about that when they say, well, I've got plenty of money to pay for it. What if it is qualified money? What if you're also living off some of the interest on that money? And now every time you take a withdrawal from that account every month, the amount of of interest, or the percentage that you are able to take down the road, is going to be less because you're diminishing your total pool of funds. So self-funding isn't necessarily the best solution for a lot of clients. They don't always think it through. So self-funding, not the greatest solution either. So what other things do we want to think about with long-term care? Well, LTC premiums. There's been a lot of press about long-term care and traditional long-term care premiums being pretty volatile in the industry. Long-term care premiums keep rising, keep it or drop it. March of 2014, double-digit premium hikes. Unfortunately, we have seen just about every carrier have double-digit premium hikes on existing policies, and in some cases on multiple occasions. Long-term care premiums on the rise. I was in New York Times again back in 2015. And how do you handle long-term care premium hikes? Believe it or not, most people that get a premium increase, they just pay the premium. It's only about 11% of the people that get a premium increase will reduce coverage, and only about 4% of the people that get a premium increase will actually voluntarily lapse their policy. So most people just suck it up and write a check. They're not happy, though, when they get that rate increase. So an alternative solution is eliminate potential premium increases using annuity care. So that's one of the products we offer. We can take a 1035 from a non-qualified deferred annuity. We grow the long-term care pool. It's pretty simple from an underwriting standpoint. 9 questions for underwriting. No phone interview, no APS. But we want to talk about asset care. And actually, go ahead and skip that one. Let's skip that one. One more. So here's a little difference between our products and traditional long-term care products. So as you'll see here, both at $5,000 a month. On the left-hand side, traditional long-term care. Asset Care 4, which is the product that we have at One America. Elimination period is pretty similar. Benefit period, essentially the same, 36 months, 33 months. Both having compound inflation, both having waiver premium. But we have a death benefit. One of the biggest objections that we see in the world of long-term care insurance is people say, well, what if I never use this policy? I'm going to spend, in this case, on the left-hand side, $5,000 a month. I'm sorry, a year. $5,000 a year. I'm 55 years old. I'm going to keep this policy for 20, 25 years. I could easily spend, upwards of $100,000 in premium. And if I die, what happens? Well, the policy's over. Whereas with the Asset Care 4, the One America product, there'd be a death benefit. You're going to get all your money and then some back, your family would, in the way of a death benefit. Cash surrender value. What if I cancel my policy in 10 years? Well, with a traditional long-term care policy, you're going to get a letter from the carrier saying, thanks for the business and have a nice day. You're going to get a letter from One America saying, thanks for the business, and oh, by the way, here's a check included for the cash surrender value from the life insurance portion of the premium. Now, will it be all your premium? No. Will it be a significant amount of premium? Absolutely, and it'll be more than you'll ever see from a traditional long-term care policy. Premiums are guaranteed. You'll never, ever have to worry about a rate increase. So even though we're more expensive up front, we offer some things that the other policies don't offer. And this isn't always necessarily true. I can show you examples where we can come in and we can be apples to apples on the premium. And one thing we didn't talk about, but we will when we get into the proposal, we also have lifetime protection. Nobody has that. So let's talk about the product. So Asset Care 4. So we have 2 components to the policy. You have the base policy, and then you have the continuation of benefit rider, which we'll show in a few minutes. So on the base policy, we can write this to anyone ages 20 to age 80. We can sell it as a single policy, or we can sell it as a joint policy. Now, when we sell it as a joint policy, it becomes a second to die policy. Now, the beauty of our joint contract is in most cases, adding the second person will add very little premium to the contract, if any at all. So it's a great way to add a second person. And who can that second person be? It can be a spouse. It could be a lover. It could be 2 guys living together, 2 gals living together. We don't care why. It could be a couple of siblings living together. They don't even have to be living together. If we can show that the two people have insurable interests with each other, that would be a couple that we could put on a joint policy. Think about this. I own an insurance agency and I have a business partner. We own the agency together. Do we have an insurable interest with each other? You betcha we do. We own a business together. We could actually both be on the same contract on a joint policy. So it's very broad who we can add as the second person. I can even add a child. The only restriction that we have on that second person is they can't be more than a 25-year age difference. So as long as we're less than 25 years apart in age, we're golden. Now, as I said, it's written on a whole life chassis, so it's a whole life policy, and you can pay for this product. On the base plan, you can pay as a 10 pay, 11, 12, 13, all the way through 20 pay. You can pay for the rest of your life on this product on Asset Care 4. So similar to traditional long-term care insurance, you can make an annual premium payment annually, quarterly, semi-annually, monthly for the rest of your life, or you can have a limited pay. It has guaranteed premiums. The premium I show you today, I can promise you will be the only premium you'll ever pay for the duration of your policy. You never have to worry about a rate increase. There's cash value in the policy, and there's a death benefit. One way or another, you will receive a benefit from this policy. Whether you cancel the policy at some point, you'll get some cash surrender value. If you use it for long-term care, there's a long-term care benefit. Or if you never use the policy, when you die, your family receives a death benefit. We have inflation options, 2, 3, 4, and 5% compound inflation. And then the next three bullets are all they're all work similar. It's how we actually pay out the long-term care benefit from the death benefit. You can accelerate the death benefit at 2% per month of the total life insurance benefit. So, and that would take 50 months to use all of your life insurance benefits. You can accelerate it at 3% over 33 months, or my favorite at 4% for 25 months. Why do I like the 4% the best? Because it gives you the greatest amount of monthly benefit. And quite frankly, the second reason I like it so much is on the next one is how you get into the rider. So on this rider that we add, which is an additional cost, you can either double the benefit. So if I buy a 2% at 50 months, I can either double my benefit to 100 months of long-term care benefits, or I can add lifetime rider. If I buy the 3% at 33 months, I can add another 33 months, or I can have lifetime. Or if I buy the 4% at 25 months, I can have an additional 25 months or lifetime coverage. About 80% of what we sell is lifetime coverage. It makes sense, especially because most of the policies we sell are also sold as a joint. The last thing you want to do is sell a limited duration plan like a 25-25, which would be 50 months total. And all of a sudden, let's say it's on myself and my wife, and I need to go on claim, and I use up 40 months of the benefits, and I die, and now my wife only has 10 months of benefits left. That's probably going to leave her short for her potential needs. But if I bought lifetime coverage, we don't have to worry about it because it never runs out of benefits. We can actually both be on claim simultaneously, receiving whatever our monthly benefit is per person. So if I bought a $5,000 monthly benefit, which is what we sent you in all your proposals, so $5,000 a month, my wife and I could both claim $5,000 a month each for the rest of our life with that lifetime coverage. So the rider is available to people age 35 to age 80. We can pay for the rider differently than we pay the base. So let's say I'm paying a 10 pay on the base, but I don't want to pay that much more premium, so I do an annual pay for life on the base. Or I could do a 10 pay, a 20 pay, a single pay. I can do anything I want. So we don't have to have the two payment options be the same. We can mix and match them. Here's another thing that's unique about our product. If I compare us to my knowledge, most, if not all, the other hybrid or asset-based life insurance products with long-term care, their entire contract is a life insurance contract. Ours is broken into two components. On the left-hand side of the screen, that's your life insurance. On the right-hand side, it's a separate long-term care policy, even though we call it a rider. Because it's a separate component, if you're a business owner, as you all are as insurance and financial professionals, you have, as a business owner, the ability to deduct a portion of the premium on the rider from your federal income taxes. If you're a C Corp, it's 100% deductible expense. If you're an LLC, etc., then it follows the age-based limits. The last thing that I want to mention, we also have inflation, and that's available as well. So here's the last line, and then we're going to go into a quote. So great way to explain, not only to you, but really to your clients, understanding the difference between our policy and traditional long-term care. Think of an apartment being like a traditional long-term care insurance policy. It's like an apartment. Generally, the premium's a little lower, or you make a lower rent payment, but you pay forever. Your rent can go up, and it often does, so you can have a rate increase. You build zero equity, right? There's no equity in your apartment, just like there's no equity in a traditional long-term care insurance plan. And you can't pass on your apartment to your kids, just like you can't pass on anything from a long-term care policy to your kids. Now let's talk about home ownership. And with home ownership, there we go. With home ownership, your payments might be a little higher. So yeah, our premium at times are a little bit higher, but we can also lock them into a period certain. So if you want to do a 10 pay or a 20 pay or something in between, we can do that. Your mortgage payment is generally locked in, so we don't have rate increases on our plan because it's guaranteed. So just like your mortgage. You begin building equity from day one. Well, that's our cash surrender value. And lastly, if you don't use it, just like you pay off your home and you pass it on to your loved one, you can pass this policy on to your loved one in the way of a death benefit. So that's kind of an example. Let's go to the quote. So that's kind of an example of how we are different from a traditional long-term care policy. Now, you all received a quote that we ran for you. Now, when we ran these quotes, we made some assumptions. So let's just be clear about that. We assumed you're married or you have a partner, and we assume they're the same age as you. And if we got your age wrong, we got your partner's age wrong, just give Dan or Nick a call. We'll run you a new quote. But we wanted to just kind of give you a sample quote on yourself so you can see what it really looks like. So at the top right, you'll see it says Asset Care 4 Multi-Pay. So prepared for, you should have your name, and then I think we just put either Mr. or Mrs. on your spouse. You see the age of you and your spouse. We also made an assumption you're all non-smokers, and if you're a smoker, that's going to change the pricing a little bit. So now let's look at the initial premium. You can see in this example, which should be similar to yours because we ran the same parameters. What's going to be different is your age, what's going to make the premium go up or down from here. But otherwise, the core benefits are the same. So the initial premium, $4,366. You see there's a death benefit, $125,000. We also built it with lifetime long-term care protection. Now, if you're a little bit more of a visual person, you go right below that, you see the bar chart. The initial premium in the bar, real small, $43.66. Then we see the little bit bigger bar, the death benefit, $125,000. Then right below that, the big bar, so it's split in half. That first $125,000 is what we're going to use right there to accelerate your death benefit for long-term care. We accelerated at 4%, which means that's a $5,000 monthly benefit for long-term care. Over on the right, up right there, that's your continuation of benefits. That's where we give you lifetime coverage. So you will never, ever run out of benefits. So right below that, we see $5,000 monthly benefit or $60,000 a year. But if you and your spouse both need long-term care, simultaneously, that's $5,000 each. That's $10,000 a month or $120,000 annually for long-term care coverage. And the best part is it never runs out. This is lifetime coverage. Now let's go into product features on the left. And you see that once again, continuous annual premium. The base policy, so that's the life component of the policy, is $2,934 a year for you and your spouse. On the right-hand side, you see continuous premium of $1,433. That's the rider. That's the component of the premium that is tax deductible. The $2,934, the $1,433 together equals $4,366. The premiums are guaranteed never to increase. We have a 4% acceleration for 25 months. Keep in mind, like traditional long-term care insurance and other asset-based products, it's not a use it or lose it. If you only use $2,500 a month, then it would take you 50 months to use up your 25-month base, because you're only taking half the money available every month from your total death benefit. Guaranteed cash value, and then over on the right-hand side, once again, benefit unlimited. The benefit period is lifetime, so it will never run out. There's no inflation feature, and the premiums are guaranteed never, ever to increase. So you don't ever have to worry about a premium increase. Now let's talk about page 2 of the quote. Pretty simple. Right at the top, once again, Asset Care 4. It's got the information about you and your spouse once again. The two columns I want to point out, the first one is the fourth column over from the left, where it says cash surrender value. So as you can see, in the 10th year, you were paying $43.66, I think, from memory, and that might be a few dollars off. If in 10 years from now you say, you know what, this long-term care insurance is for the birds, I'm canceling my policy, I wouldn't recommend it. But if you did, you would see a check from One America for $22,592. So a pretty significant amount of your money you're going to get back, and you had coverage that entire 10 years. Assuming you didn't use any of the coverage, that's your cash surrender value. If in 10 years you and your spouse are both tragically killed in an accident, your beneficiaries are going to get $125,000. In fact, let me change that example. You buy the policy today, and next month you're on vacation and the plane goes down, and you both are gone. Your beneficiaries are going to get a check for $125,000. You made one premium payment. That's a pretty good deal. And then lastly, on the far right-hand side, it shows, excuse me, what your annual long-term care benefits is. You see that it's lifetime unlimited at $60,000 per person per year. That's all there is to it on our quote. Now, one of the reasons our quote is so simple and we don't need a signed illustration, when I look at my competitors, and there are some great companies out there that have similar but different policies, what we bring to the table that makes our product so special, first one, our joint contract, we have a patent on that. You don't see any other asset-based product that is in a joint contract. And the reason for that is we have a patent on it. We have more ways to mix and match premium payments than anyone else out there. But what we also do that's different than anyone else out there, to my knowledge, our contract is 100% guaranteed. When I look at all the other that I've reviewed, and I could be wrong, I haven't looked at every one, but when I look at the other major carriers that have some type of an asset-based product, what they have is an asset-based product that is guaranteed the death benefit, guaranteed the long-term care benefit. What's not guaranteed is the cash surrender value, because the internal charges could change, and that's why they have 12, 15, 18-page quotes that you have to be signed, because you do have the potential that your cash surrender value could be different. Everything in our contract, including the cash surrender value, is guaranteed. So therefore, we don't have to have a signed illustration, because what we show you with our proposal and with our contract is 100% guaranteed. So with that, I'm going to ask Dan to open it up. Questions, you can either type them in. Can we open the lines too? We might be able to open the lines, but you can absolutely type in a question if you have any questions at all. And of course, you can always, after the call Nick or Dan, and they are more than happy to, one, provide you a new quote if we have some information wrong, or you just want something a little different, or if you have some clients in mind that you want to quote for, or you just have questions. So with that, if anyone wants to type in a question, please do. So here's a question that's come in from the audience. So one of the questions that we just got was, is the only way I can pay for this product annually, or 10 pay or 20 pay? And the answer is no. We actually have, what we showed you was what we call Asset Care 4, which is our pay-as-you-go plan, most similar to a traditional long-term care. We also have the ability to single pay this product, or we can single pay the base and the rider, or we can single pay the base and have a small annual premium on the rider. We also have the ability to use qualified money. Once again, we have a patent on that. There's no other company with an asset-based product that can use qualified money. And the reason for that is we have a patent. And the way we can use that qualified money is we actually take the qualified money, we put it into an IRA annuity, and then we take 20 distributions from it. So it minimizes the tax impact to the client. They still are going to have to pay taxes, but we take the withdrawals over a 20-year period of time, so it's a minimal impact to the client from a tax liability. And if they're over 70 and a half, those distributions coming out of that IRA annuity that we've transferred the money into count toward RMDs. So it's a great way for a client that's maybe got a lot of money in qualified accounts that aren't going to be using the money, that have assets to protect and don't have a long-term care plan. A great way to use those distributions every year to protect their entire portfolio. Let me see if we got any more questions. We don't have any other questions, so I'm going to turn it over to Dan to make some closing comments. And I just want to say, on behalf of One America, I really appreciate you giving me the time today. And Dan, it's all yours.
Ken, thank you for that. That provided us with a tremendous amount of value. I hope that provided you guys with a lot of value as well. Thank you again for your time today, but more importantly, thank you for your partnership with us. We truly do appreciate it, your hard work out in the field. And Nick and I, we would encourage you, send us 2 or 3 clients that came to mind today. We'll put those proposals together, get them out to you today still. If you have any other questions, please don't hesitate to reach out to myself, Nick, or even Ken directly. And with that said, please have a great rest of the week.